we all agree Palantir is overvalued. We're not discounting that. It is. It's been at $30. But to justify it going back to $40 because of this other stock is worth this amount is absolutely dumb.
Welcome to Investing with the Boys, brought to you by Futurum Equities, guys. This is episode 20 coming at you live, probably for the first time we've ever done this entire series. And we are going to talk about markets as they were today because, I guess the only thing I can say is that I have no idea what's happening in the market. I think I know what's happening in the market, and I think you guys do, but we're just going to speak to our best ability just to take it all off. We were down on the Qs about 2% earlier this morning, and the SPY was down about 1%, but we have basically done the intraday bounce where a lot of high growth stocks, including Palantir, have had a dramatic recovery. And for the technical traders out there, closed above the 50-day moving average, I believe, which is really important when you think about these high growth stocks for a lot of traders and also a lot of people who are buying into it. But in my opinion, do we think the market's going to fall off a cliff and have a correction? Well, that's going to be answered throughout the show. So tell us your thoughts, Logical. How you doing, man?
Yeah, it's been pretty choppy action overall. I think the chop has actually started weeks ago. We saw, I hate to use this word, stealth correction, but there has been weakness beneath the surface for some time now. It's just that the leaders continue to march higher. S&P, which is the market weighted, kept going higher, putting in new highs, but breadth was actually breaking down on, the back end. So I think what's really nice is that in the last week, we've seen breadth tick up, but clearly the last couple of days, now you're seeing some of the leaders break down, you're seeing some of tech break down. And so I'm just kind of thinking, are we still in this chop zone? And I think the answer is probably yes. So I don't want to make a call one way or another. What I do want to do at this point in time is just get to a point with my portfolio where I have manageable exposure. I don't feel, too aggressive, too underexposed. I want to sit just right. I think recently, like last week, we had kind of that breadth expansion on Tuesday, Wednesday. I started getting a little bit more bullish and constructive to the upside. Okay, maybe we're ready now to take that next leg up in a lot of these names. But then we just quickly, broke down just after that. So I took some of that excess exposure back off. So I'm just very fluid and with my exposure, and I'm just trying to manage. But there's still a ton of opportunities in this market. I know some people are, fishing ex-US, and I get that too because there's probably higher value there. But I still think there's a lot of sectors that can offer a good opportunity here. I've always been very vocal about the biotechs. Today, they finished green on the day, which is nice to see. So they bounced actually harder than a lot of other sectors. We saw, value and things like that catch a bid recently. It could be rotation. I think maybe the trade of short small cap, short value, long tech, long growth, etc., long high beta is going to be unwinding a little bit. But it doesn't necessarily mean that trade is necessarily over. It's just maybe gone a little long in the tooth. So I think the beginning of some of these rotations end up being an unwind of that trade, which is what we've seen. People cashing in their chips after, Palantir is up to, it's up like 25x in 2 years' time. And then they've just been shorting the Russell. Basically, shorts on small caps have been at all-time highs, especially as there's been a high rate regime. So, do maybe some people start selling their longs, buying back their shorts to cover, especially as we head into potential rate cuts? I think that makes sense from a prudent risk management standpoint. It doesn't necessarily mean that that's a signal to get long some of these things, but, I'm obviously a small cap investor myself. So I'm hoping that we're kind of turning a corner there, and less shorts mean that, there's less aggressive positioning to the downside. So that's kind of what I'm looking for, is just hopefully some healthier rotation, more breadth expansion in the market. Maybe we can stop focusing on the same 50 names. But in the meantime, I think the best thing you can do is probably just be in a very manageable position in terms of your exposure, where you're good, even if we pull back a bit more. And again, it's that seasonal period where you can, 2024, we pulled down into August 5, which was the Japan unwind, the yen carry trade unwind. And then in 2023, we had I forget exactly the reason for why we had that July to October. It feels like ages ago, but we had like a 10% pullback then as well. It just feels like, what was it?
The carry trade.
No, that was 2024. What was 2023?
Oh, that was recession fears.
Recession fears, of course. Yeah.
Yeah, no, of course. No, that started from the downgrade.
I think, yeah, okay, that makes sense. And here's the thing, right? Like we just constantly in this market, it's like a pendulum swinging from recessionary fears to inflation fears. So anytime, and then we get into the stagflation conversations, it's like every 3 to 6 months, it's like, clockwork. So I think every time it gets too bearish to one side or too bullish on the other side, you want to kind of fade those extremes. And always what I like to say is that the truth is somewhere in between. I think that this is still a healthy bull market. I think there are still pockets of froth. I would love to see some of that froth and excess come out of the market. That could mean further, downside pressure to equities, but it doesn't necessarily mean that it's the end of the bull market. It just resets things. It gives you a way to set up for the next leg. And ultimately, just look for things that you feel comfortable holding, confident holding, high conviction in. Manage your long exposure. I don't want to be underexposed in this market, but I just took down some of my aggressive positioning just because this chop is really annoying. As soon as you think you're out of the woods, it comes right back. And so I just want to be able to manage through this chop. I think there's like this thing that where every few months you get this uptrend and it's just the easiest money to make in the markets. And then you get a few months of chop where the market goes nowhere. And so what you really want to do as a stock picker, as an investor, is to survive the chop and then ride the uptrends. And so right now, I still feel like we've been in this chop for a little over a month now. I know S&P has made some highs, but in the meantime, really it's been kind of sideways. And so it's expected after you had a historic run after, April to July. So, I mean, it's healthy. We should consolidate. Every 3 months that passes is another earnings of growth that we get to see priced into the valuations, which means that basically if a stock goes sideways for 3 months and we have another earnings report, the stock actually gets cheaper and we get multiple compression. So it grows into its valuation. So to me, it's very healthy. And yeah, I mean, that's it. Just survive the chop, wait, and eventually we'll get an uptrend. And I'm not calling for a huge pullback, still a healthy market, but just be ready and just survive the chop. And you can always add on exposure after when you feel that we're ready to head on to the uptrend. But I'll pass it along to Shai, get his thoughts here.
Yeah, did you buy the Palantir dip?
It's over, guys. The market is going to tank to all-time lows. No, I think, first off, we're in the most obvious seasonality weakness period out there. Everyone and their mother predicted profit take is going to happen in August. Don't count all the chickies in September for Powell cut rates. I think it's the timing of why the growth stocks have been so aggressive on their pullback is the Powell Jackson Hole speech on Friday. There's a lot of hot takes on what's going to be the tone of that press release. A lot of people are anticipating to be hawkish due to something of a political will that's being forced down Powell's throats. Even though the Fed's independent, you're seeing a very open POTUS on telling them what he wants. And whether or not Powell wants to admit it, in fact, the rate cuts are coming. And if it's not going to be him, it's going to be whomever takes his position. And you're seeing a game of sorts on all these Fed chairs trying to angle themselves in Trump's favor because everyone wants to be the rock star. Like, these are ex-lawyers, a lot of these people. Do you not think that this is like one of the few avenues where every month or probably every couple weeks, whatever they say has a huge weight on the equity markets? They get a lot of spotlight. They're on every legacy media outlet. That's rock star level. And I think that right now the seat's open for taking, and you're going to see a lot of fudgery happening. I think that's one aspect. Second aspect is, the Trump administration is taking out Fed chairs one by one. Like, I forgot who, I was just on Fox today, and the person before me, there was a panel speaking on, I think it was Fed Chair Cook is the one that Trump is looking to fire because of something that's kind of sketchy happening. There was an argument to be made that maybe Powell stays on longer because there's some worries of Trump stacking the Fed chair in his favor. Like, there's just a lot of drama that's being happening regarding the Fed, and the market has been V-shaping aggressively on every dip we've had, like yen carry trade crisis, tariff wars, and we are in that season of weakness where sentiment is very fragile. Like, and it won't take much to really turn a narrative. Liquidity is super thin. Every sell-off feels somewhat exaggerated. Like yesterday, I mean, Palantir, for example, we can get into Palantir because Palantir went down 20% in a week. I actually don't remember the last time that has happened because of the sheer outperformance that they've made on their earnings report every 3 months justifies why they are the stage 2 AI winner. Now we have Citron saying that Palantir should be a $40 stock. And the justification is just so freaking dumb. I can't even describe how dumb it is. Like he also went on after me on Fox. I kind of felt insulted that my name and his name is kind of connected with one another because of how dumb his reasoning on why Palantir should be at 40. First off, high evidence. It was a ChatGPT wrapper. He was like telling ChatGPT, brute forcing it. How can I make the argument that Palantir should be at $40? And you could see exactly how he got his answer. It's very obvious. We all agree Palantir is overvalued. We're not discounting that. It is. It's been at $30. But to justify it going back to $40 because of this other stock is worth this amount is absolutely dumb. That is the weakest type of argument you can make. First, it was OpenAI, $500 billion. Okay. Now you're saying that Palantir should be worth $40, which is what, 75% lower than what is that? You think Palantir should be worth around $100 billion, essentially, if OpenAI is worth $500 billion. Do you see what kind of growth both companies are kind of getting right now between those two? Like, you're seeing OpenAI have a pretty attractive high-level numbers, but it's money losing. Like, if that makes sense. Like, it's. I wish we had the link to share so we can talk about it and show it as I talk through it. If one of you guys want to find it and post it in the chat, we could do that. But they have a similar level of revenue. One loses a substantial amount of money. Palantir has 45% free cash flow margins. This isn't growth at all costs. It is growth at a sustainable, responsible way that's extremely sticky. Other argument was customers. Palantir only has 800 customers-ish. Do you not think that's a bullish tailwind that they're making this much amount of money when they have less than 1,000 customers? How many enterprises are there out there? Thousands. Eventually, this justification that it's worked on the first 1,000 customers at this scale and this kind of adoption is going to accelerate drastically as the theme moves on. Do you want to share that screen, this link over here? One of you guys?
Yeah, Taylor's going to bring it up there. But that was actually a Databricks comparison.
Oh, so we'll do the Databricks one.
Yeah.
That's even more of a ridiculous comparison because I'm an investor in Databricks. I'm not touting my Palantir book. Databricks is the top 10 position. Palantir is number 1. It's such a different business. It's the same argument that was made on why you should never compare Snowflake and Palantir. It's like the comparison of SoFi and Robinhood. The same argument that Citron's making for Palantir is like, oh, Robinhood's worth $100 billion. So if SoFi is worth $25 billion, Robinhood should probably be worth the same.
Actually, Robinhood and SoFi are even closer related. Like, these things are so far apart. It's not even.
No, they're very far apart. Yeah,
they're not even the same
they have a fintech wrapper essentially. But but Databricks it's an actual SaaS company. Like, it really is a SaaS company. Yes, they both have probably the two best AI machine learning application that's going to be built on top of AI. When we talk stage 2 AI winners, who has the lifeboat that's going to survive the AI tsunami? It's for sure Palantir. It's for sure Cloudflare. It's for sure Axon. I think it's Databricks. I think Snowflake has a life jacket. They don't have a lifeboat. I think ServiceNow has a life jacket, no lifeboat. But those are the fearsome foursome of stage 2 AI. But they're so different. And one's losing money, growing the top line 50%. The other is growing 50% with 40% operating margins. Drastically different. And I think that the only weight that he had behind his bearish take of short report was because of this company is worth this much. And I'm telling you, they're different businesses. What do you have to say about that?
So, I mean, I think it's kind of a joke, their short report, not because of the fact that what they're saying doesn't make sense. I mean, clearly Palantir, it's overvalued, right?
Well, first, before you continue, like I do want to say, I forgot to say, Snowflake and Databricks are partners inside Palantir's ecosystem. They're not direct competitors. Like, it's just so different.
There are companies that do partner with a competitor to a certain extent, but in this case, like they're really different platforms. Like if a client gets AIP or they sign up with one of the other products from Palantir, it's going to be customized, right? They're going to hire the engineers of Palantir to customize the application to their company's database and integrate all the applications with it. When you do Snowflake or Databricks, it's mostly vanilla product, right? You're going to take it for what it is and you're going to do the integrations, everything yourselves. Yeah, of course, you can hire these SaaS companies, engineers or consultants to set it up for you. But at the same time, that is really not what's not driving the product's recurring growth when it comes to those companies. Palantir, of course, does have that recurring growth, but they have two verticals that they're getting into. They're getting into government and they're into U.S. commercial. And we haven't really seen the dramatic increase when it comes to international growth. Now, with that being said, I don't own a share of Palantir. I wish I did. I wish I held on to my shares, but I didn't. But besides that fact, even on a technical level, the stock is like 50% above its 200-day moving average, right? So to even think about something like that, revisiting a 200-day moving average at $100 to happen, it first needs to break the 50-day moving average, which it couldn't even close below today. Might close below it maybe next couple of weeks, who knows? But at the same time, and I've said this on the spaces lately, is that if you are short a company, right, and you're a big firm like Citron, you want all the media to blast out this short report out there. You want controversy and you want people to start shaking in their boots who own Palantir. And you want everyone to sell their Palantir because they're afraid that it's too expensive, whatever it is. You want that attention put on Palantir and not in a positive light. You want a negative light. Why? Because Citron's going to make money every single tick it moves down. At this point, Palantir has dropped nearly 20 to 30% from its all-time highs. That is around the time when Citron did go short Palantir, around $180. They doubled down when it was at $160 or something, right? Well, they could have covered. They could have covered their position. If they covered their position, they made a lot of money off of it. And then, yeah, they can continue to say it, but whatever they say is not what they do. If you look at certain SEC filings, from what I've heard, I haven't checked it myself, so please do your own due diligence, is that they're doing a lot of trades as these short reports do come out. And with that being said, this is also related to muddy waters with AppLovin. They threw out their short report there and they were already short they were already short AppLovin. And it even stipulates in the short report that we could be covering our positions at any point. So what if they did do that? What if Citron already covered their short? Well, do you think it gets $40 or not?
Well, I also think it's a combination of there's a double top in the market. They saw that it was potentially going to be a pullback, seasonality weakness. Palantir is the most hated winner out there. I think a lot of people hate that dumb money won so aggressively, 10x type of thing, and institutions were on the sidelines, didn't see the opportunity that a lot of retail did, and it was just extremely hated. So they knew there was going to get a lot of eyeballs, and I think that the way to know that everything that Sam and I are saying is very accurate on why they're off, but there's one specific tangent. It's still subjective what him and I are saying right now, but the actual binary reason why they're absolutely false and probably use hallucination on a ChatGPT is they're saying there's going to be a 25% CAGR for the next couple of years on Palantir. Every Wall Street estimate is 35 to 40% CAGR. That's so drastically different to justify a $40 price target. It's just legit making up numbers. And I think we spend a lot of time on Palantir. We won't get into it too much because it is a lot of time and effort, but I think there was a reason, like the market needed a breather. I'm fully aware of that. It's still at 100 times EV to sales. Again, I think it's the laziest metric to use for a Palantir because they have a Rule of 40 score of 90. You don't use EV to sales, but it's still the most expensive among its peers. Not denying that, but it's also deserves a premium because they have that AI lifeboats. When you see how ugly it's been in software the past month or so, nobody really knows who's going to be the winner of this AI tsunami that's coming. That's the thing. And what were you going to say?
Ugly is like not even close to describing how nasty it's with software stocks. I just want to add that. Go ahead, Logical.
Yeah, let me cut in real quick too about Palantir. One, yeah, I mean, I think market timing is really important when it comes to shorts of market leaders. And so they're probably monitoring liquidity and how much more can people buy this thing, and if everybody is long. And the thing is, when people are chasing a stock like Palantir at 180, I mean, I saw like, I don't know what it was, like 220 calls come in or something like that. It's like, momentum begets more momentum. But as soon as there's a technical breakdown, a lot of those momentum chasers end up ditching their calls. And so when they have calls short dated, they have a ton of contracts. That's a lot of leverage in the position. So whenever they dump those calls, that causes an unwind from the market maker's perspective. And so quickly breakouts can become failed breakouts, and then they can, break down. So I would say from a market timing perspective, they probably were just monitoring liquidity. And yeah, it was bound to happen. I mean, this thing can't just go up forever. It's even after this pullback, it's still up 380% on a 12-month trailing basis. Sorry, go on.
Well, no, here's the thing. Like, I think if you go back to the .com era, clearly the winners were the online marketplaces built on top of the structure already of the internets. Amazon, Google. I really believe Palantir is going to be that winner in the AI era. And if I believe that, I think there's worlds of evidence to just back it up as well with how much they're beating their earnings reports entering 2025. Like, I think 2025 alone, they've got it up $700 million on their top line. That's insanity.
Shai, the only thing that I'll push back on here, though, is that at the end of the day, they're still kind of like a consulting company, right? So they go into a company, they get a project, and they build them like this custom AI solution, right? That's the idea behind Palantir.
No, it's not a consulting wrapper around a SaaS company or a software offering. I really do believe it's just becoming the brain, like actual brain of an enterprise. Like, it does everything. It touches every single aspect. If they're in every industry, they must be building custom solutions for those specific companies, no? They are. There's a white canvas approach, and that's why it takes forever for them to really scale up once they get client adopted.
That's my thing, right? Scalability. I think that's my only issue with the Palantir is like, yes, the metrics are insane. They're early in their growth curve, and that's why they're putting up these numbers, and more people want to have these projects at their company. But I wonder, like, how are they able to continue to scale up? And that's where, like, the comparisons with Snowflake or Databricks, which, by the way, makes zero sense at all. They're not even the same business. Doesn't make sense. One's a kind of more consulting, building custom software. The other one is like the data warehouse infrastructure, which will scale at ease. So that's kind of where I'm really like pushing back. I just don't know about the scalability of Palantir, but clearly they keep doing really well. But yeah, that's a big point of like difference between. Like, I don't
your
know.
Question is, how can they scale out? I mean, they've been reducing headcount consistently with their customer growth growing and the revenue as well, and also NRR, right? So that already tells you themselves that they're able to do it. How they're doing it, I don't work there. I don't know, but they're probably
they also don't reveal it. Like, nobody knows. It's very much a black box on purpose, I think, because they got that sauce. They got that AI sauce they want to keep in house, and I think that. If you want to compare, like, I keep getting this question on, like, why are they so different, Snowflake, Databricks, and Palantir, when they're all data intelligence, essentially. I like to use a metaphor of, like, Snowflake and Databricks is the library and Palantir is the librarian, where you see these, like, the Databricks and Snowflakes, their power lies in elegantly organizing all the chaotic data out there in a really structured way.
Accessible.
It's accessible. Yeah. It's like, if you guys think things are fragmented and siloed now, like, the world's going to be drowning in this once agentic AI or AI agents have that ChatGPT moment. It has not happened there yet. We're years away from AI agents having a ChatGPT moment, to be honest, because of all the structural corporate governance we need in order for it to really scale up. But I think that going back to that reference, you have to think about Snowflake and Databricks. They are like building these new aisles and passageways to like let these LLMs, let these AI applications and agentic AI in the future kind of read directly from the stack. Like, you can do a lot of like analysis now in Snowflake's system, where before, like, logically, you could probably speak more on this. You used to have to take a SQL query and do it externally on an Excel sheet or do somewhere else. Now you could do it actually in their actual product. So I think that's a big difference. It's no longer a warehouse anymore because of that.
Yeah, it's a good point. I mean, it's the virtualization layer that's in between all your different databases. So it connects all the data into one place. So if you have like all this data being stored in different places, it brings it to one layer. And that's what you're querying essentially now. So again, like, I just don't understand when people are, it's really funny because we've seen the takes on Twitter about like, they're bullish, Palantir or something, but they're bearish Snowflake or Databricks. It's like, or they're bullish Databricks and bearish Snowflake. I just don't, I don't really get the takes, to be honest. Yeah.
Well, I will say though, like there is some, like I mentioned, Snowflake has a life jacket. They don't have a lifeboats for AI tsunami. Palantir does. The reason for that, Snowflake's still a layer, and that is at danger in the future because layers are getting removed. Where for like Palantir, for example, like they're so different than the Databricks and Snowflakes out there because data doesn't move in the world on its own. Like that's where Palantir comes in through that decision engine that's built on top of all these LLMs, where it's so much of a system level intelligence that understands, going back to the library metaphor, like which books matter for your question, like how they all relate to each other, what should be done with what's inside them.
I have a question for you though. I mean, all these LLMs, a lot of them are open source. A lot of people have access to them. Someone else can come around and become, I'm not saying they're going to beat Palantir, but if Palantir is charging the premium prices to enterprises, then if I was a smaller enterprise and I wanted a good enough solution, why can't I go to an upcoming competitor or something like that?
Yeah,
I actually think they have a moat. I think they have a moat. I don't think anyone can really do what they do right now. Like, I think that you have to, again, going back to my ChatGPT moment for AI agents, like I think, yes, the capability might be possible, but the actual governance to having all the guardrails to make it safe and okay, that's being under indexed a bit on what Palantir is able to offer. Like, remember, they were the government's consultant black box for over a decade. This is purely like validated from the government. It's safe. You can scale it. Like, it's going to be the guardrails. Yeah, maybe an AI native customer can create some kind of decision engine on top of their LLMs, but I just really don't think there's a capability. It's not worth the effort for that, to be honest, because at the end of the day, you save so much money through Palantir's ontology that the capex up front for like these LLMs, like the OpenAIs, Anthropics, all those, etc. Like it's kind of it's really difficult to solve, and it's going to cost a lot of money. And if you F that up, you missed out on what your bread and butter already was. So I do think that maybe you're right. Like maybe there's a world where it gets solved in a decade plus, but I just see it.
They are still, I agree, because they've had these government contracts, so they've kind of become the one. They've been, they've gotten that crown. But I guess two things I would think about is it's a $370 billion company. So I don't know how they scale up that revenue in time to catch up to that kind of valuation. And then two, if there would be upcoming disruptors as AI tools become more and more competent and capable. Because that's like kind of the risk for a lot of software stocks. And again, I mean, I still think Palantir, even if it dropped 50% from here, would still end up being one of the best stocks in recent history. But it's still a $370 billion company after a 20% drawdown. So, thinking about that.
Here's the thing. Like right now, I'm looking at the estimates right now. I actually don't know of another company outside of NVIDIA which does have a cyclical risk associated with it. For the rest of the decade, Palantir will have a rule of 80 plus score every single year. That to me is like, holy shit, it starts compounding because they're printing cash year after year incrementally.
Okay, that is crazy impressive. But then I got to ask you, do you not think that is being priced into today's stock price?
I think we're actually, right now it's 35% CAGR. I actually think it would be 45 to 50. I think it's actually going to be a lot higher.
Such a tall order. I don't know. I feel like
that is just because the customer, the current customer count they have right now, the way their commercial side of their business is scaling. Like again, remember, estimates earning this year were $700 million than what the current estimates are right now, halfway through the year. It's not just like beating it; it's slamming the door shut on how much they're capitalizing on this moment. There is an argument that the first mover advantage we'll see as the theme matures, as potential competitive landscape changes. That might be accurate, but it's, I think, more difficult to poke holes in that than
Okay,
to
so
see
what I will say is that they've been accelerating their revenue growth for the last few quarters, which is very impressive. Like 27, 30, 36, 39, now 48. That is very impressive.
and these are large numbers, bases.
And that is getting larger and larger, which is, yeah, I mean, I agree. I get what you're saying, but 45% CAGR from here for the next 10 years would be like this thing. I mean, when you do the math on that, like the revenues that you're implying are like, I don't know, like 100 billion at that point or something like that.
No, I think they make 20 billion by 2030.
I don't know what that CAGR is, but I'd have to look that up. I mean, I'm just saying 45% CAGR for like 10 years would be nuts.
I hear you, but at $20 billion by 2030, they make, right now I'm looking at the free cash flow. There's anticipating 50%, which is crazy number for free cash flow margin. There's analysts on estimates, not me. But if I think 20 billion, 50% free cash flow, they're printing $10 billion of cash every single year going on from that point on. So now I get it. I'm not saying it's I haven't added a Palantir since the 20s, guys. Like it's at 150. I'm just saying it's a safe haven where software is going to be, in my opinion, a bear market for years. I don't think it's getting out of this anytime soon. I really don't think so, because narratives take a long time to get out of. If you think it's going to be like an AI tsunami is coming, it's not going to like, oh, this one quarter things are great, we're going to go back to business as usual. It's just not going the way it's going. Like we've made a comment on this podcast where nobody wants to own a house on SaaS Avenue. Everyone's trying to move out of that to agentic cloud platforms. That movement is not going to be able to happen in months. It's going to happen in years. And there's always going to be this anchored existential risk associated with this grouping, that it's going to like limit a lot of these multiples. Like I don't think they're ever going to trade at 40 times free cash flow multiple during this narrative issue. I really don't. I think the new reality is 25 times, and it's going to be anchored to the issue of the software might be a commodity in the future. And how do you price a group that went from premium because their business model economics were just so chef's kiss to now it's a commodity? That's a huge 180 on narrative. So I think that if you want that,
yeah, I feel you. I'm just wondering if like the Palantir is going to end up being in a similar boat 5 years from now. Could it possibly become commoditized?
To see some kind of competitor to.
Well, that's what I'm saying. There's no competitor today.
Yeah.
If we're increasing margins from 30 to 40 to 50%, capitalism tells us that there will be new entrants at some point, and they won't be able to hold those.
No, that's true. It's true. So, I also think a duopoly though is more enough to eat at the table with the duopoly.
It's not being priced for a duopoly. It's being priced for a monopoly here. And I think that if you think about NVIDIA, there is no duopoly with NVIDIA. It is just NVIDIA. And yes, they're going to lose some of their market share, but we're talking about TAM that's having massive CAGR over the next 5 years in terms of data center. So there was always the argument that an AMD is going to catch up. But guess what? When AMD catches up to NVIDIA where it is today, NVIDIA is going to be 5 more years ahead, right? Yep. It's going to be the state that Palantir or whatever is going to come up beyond it. I think that that's what Palantir is getting a lot of the premium valuation for, because there really is no competition when it comes to Palantir and the product that they do offer. There are other solutions, but you also have the government sector that they have growing as well. And again, like once they start tapping into international markets and sovereign governments, it's going to be a whole different ballgame. I think that 45% CAGR sounds crazy right now. I haven't really seen that in my modeling or anything, but I just seeing the way the market is today, like no one expected them to sequentially accelerate revenue for the last God knows how many quarters. I can't think of it off the top of my head, but they've consistently beat expectations left and right, even though the expectations were already elevated. And earnings growth will always track the market's will always track a stock's performance over time. And Palantir has just done that. They've done it every single time. And that's the only reason why the stock stays elevated. So if we do have the 45% CAGR and then we have like a 1 or 2 quarter blip, the stock's going to get destroyed. Yeah. Right? But right now, as we see it today, nothing's changed between last quarter's report earnings, which is at the beginning of the month just a few weeks ago, and today. Only the fact that on a macro level, things are not looking so great with the market. It was a little top heavy with tech, and these are kind of rotating, not necessarily going to get a 10% pullback or 15% pullback, but see a little bit of a rotation when you look at the individual S&P sectors alone. All of tech, XLY, consumer discretionary, XLK, tech, and XOC Communications, which is basically 40% Google and Meta, both those together, they were the only red sectors in the entire market today. Meanwhile, you had other names, including defensive companies, and you were saying earlier that XBI had quite a bid from the lows this morning. Then you see it in a lot of other stocks. They could still elevate. The market could be just fine, and people are going to be sitting here waiting for the shorts to print so they can buy into the market and buy what they missed. And we'll see what happens. I feel like what a lot of people do get lost in is relating the fundamentals directly to the stock price on a day-to-day basis. You can hit Palantir, like you said, is up 300% year to date, right? So, okay, fine. It's not up 5 million % year to date. Now it's up maybe a quarter, maybe 3/4 of that, whatever it is, whatever the amount was, right? But that doesn't really change. Nothing's changed since their earnings a few weeks ago when everyone was like, oh, wow, they did 48% growth and so on. Like, that was crazy that they did do that. I didn't expect that. But nothing's changed other than just sentiment on it. And that's really what Citron was gunning for in this whole thing, taking it back to what we were talking about at the beginning. And that's what a lot of these short reports do. They want to scare people, right? How many of these short reports actually do come to fruition unless there's some accusation of fraud, right? Of course, Muddy Waters has hit the nail on more than a few short reports that they've done in terms of scamming. And what was that? Also, Luckin Coffee in China, that was 2021, different time. But did they nail it with AppLovin? I haven't seen it. The last quarter definitely didn't show it. And the stock was pretty much near all-time highs recently, right? But it's high beta. High beta will always have those high volatility up and downs. And I think people need to understand that just because Palantir pulls back 20% from its all-time highs, it's not going to $40. Like I failed to see Palantir going to $40 without seeing a dramatic pullback in the entire market on its own. Because let's face it, man, 40% or 50% of the entire index is tech. And the entire theme has been AI. Palantir is on the forefront of AI from a software perspective. Who's the forefront of hardware? NVIDIA. If Palantir falls back to $40 with a 75% haircut, the market's going to be like 15% down. There's no way that's going to happen without
way more
being down. And I feel like people don't really understand the argument. It's like Palantir is overvalued. Yeah, well, so is SP 500, right? And who are the leaders in SP 500? Mega cap. If you take away that AI theme from under the belt, we're going to have a nasty bear market, right? And we're in that. Yeah, like deep sea capping. Palantir pulled back like 50%, right? Remember that?
But do you guys think their pullback's actually going to happen under 50, or it's going to consolidate for a Tesla like 4 years? Like Tesla stock has not moved 4 or 5 years at that.
That's what I was saying.
That's a different story. Tesla's a hardware company.
That's exactly what I was saying.
That's the narrative it's been for a while.
No. That's why I think Palantir is going to experience right now during this S curve for themselves. Let the valuation catch up. But Citron's saying 75%, like you're delusional. You're delusional because it's not going down 75%. It's going to consolidate in a very Tesla 2021 to 2025. Different business models. You're right, Sam, but it was a demand vacuum that they're pricing in way ahead of the reality. And a lot more happened for Tesla stock than actual business. But
I mean, I think
it's going to have a similar chart, I think.
Do you think Tesla would have experienced that much of a drawdown if rates were still at zero? All aside the whole GameStop stuff happening, do you think the demand in auto buying would fall off a cliff like it did, especially for EVs, if rates were still very low? You think that would still happen?
I think so, because I think that Elon saw ahead of the curve that EV was not really that much of an add value. Hybrid's good enough. I think right now we're seeing that the EV theme was a dud. And it's justified. And maybe COVID was the reason for that, because people don't drive more than 60 miles anymore. It was like remote work from home. You can move to, you can essentially, you're not going to get a job unless it's like within a certain amount of distance. You'll work remotes. If it's can't find one, like I think that EV, that theme is a dud. It doesn't make sense economically. Hybrid was a good enough solution. I think that he was going to I think he was always going to sacrifice his EV business for the autonomy and software.
Yeah, exactly.
I think he always was. So again, similar fashion, when you go through a transition that drastically, the 180, it's going to take a very long time to kind of phase that, to eat it, digest it, and release it in a way to get past it. So I think to answer your question,
45% CAGR for the metrics. Like, honestly, I don't want to say you're wrong because Karp can do it. Okay. Like when you think of how crazy a business runs and how software is, it's just in general for a lot of CIOs, like they usually, a lot of CIOs go for the hot product, right? They go for the product that everyone's going for because they want to be competitive. But that happens a lot with software. That's what we saw in 2021 and so on. Oh, go ahead.
Well, no. What percentage of enterprises are still on-prem right now? Do you know, like in the world?
Oh, I think there was a statistic. I think Jassy said this. It was like 85% of all hardware is still on-prem, which means that they host their own compute in their own data centers. Like they don't use AWS and so on.
So you need cloud to really capitalize on AI, guys. Like, so I'm saying it's so early right now. And if you're me who believes that AI is going to cause an indefinite demand, I think that's going to accelerate a lot of these on-prem customers to go to the cloud to capitalize on AI because it's such a lever to pull for margin expansion. And I think that right now saying that 15% of the world's only using cloud, that shows how many customers it's up for grabs in these industries that you're clearly seeing Palantir dominate. And word of mouth is everything in AI. Trust is everything in AI. Palantir has that in finance, has it in healthcare, has it in logistics. Now, all these boring dinosaur industries, they own that space. And 85% of the world is still on-prem. Plenty of runway. That's all I'm saying. And maybe it's wrong in the next 5 years, but eventually, So
you're thinking they do 45 CAGR for the next 5 years or next 10 years, or what's the thought?
I think that it's going to be they're going to hit 20 billion by 2030. I think. What is that CAGR? Maybe 42%.
Yeah, it's like 40-ish. Mm-hmm.
I think that's very fair. I think that
that's incredible. If you actually think they deliver that, I've never seen a company do that. Have we seen a company do that before? I don't know.
NVIDIA. Yeah, I guess that makes sense. Yeah, but NVIDIA's is way higher, actually.
They're triple digits. There
you go. So here's the difference between NVIDIA doing a 45% CAGR or whatever they did and Palantir doing it. The difference is that NVIDIA's stock price was well below. Like, we already did the move, like the NVIDIA move, but for Palantir. So they still need to. So we're pricing in that 45% CAGR that you're talking about. But you get what I'm saying? Like, we're already at the price point. I think that it would need to grow into that valuation. That's
what you're saying, right? I don't.
That's what I'm saying. It's not going anywhere for 4 years, I think. And I think that by 2030, they're going to be printing 10 billion a year in cash. Right now, they're at
anywhere for 4 years. Why would you hold this stock? If it's
because I'm up 800%, I'm not paying taxes on it.
We are literally talking about like investing versus trading and opportunity cost.
Exactly.
Like, very different.
Wait. No.
We've talked about season one.
No. We're talking about opportunity cost of that capital. You could use that money for something that's going to appreciate over the next 4 years. You're telling me you would sit in something that has a 0% expected return for the next 4 years?
First off, I've thought this about Palantir since $60. And also,
that's fair, but now we're 3 points higher.
No, but that's the thing, because AI is exceeding everyone's expectations. Like, everyone's like, there's no ceiling right now on this. There isn't. It's never been a product, a thematic like this in our lifetime. Cloud.com era, they were not as the ceiling is not as high on those themes as is in AI. But I hear what you're saying. Like, why not trim 10% of our portfolio and have 10% cash? I have 15% cash already, and I have nowhere else to put it right now. Like, I rather focus on the winners.
Right. Why not just add more to your other existing holdings then? And why not we feel that you have a higher CAGR there? I mean, I'm just speaking to you as a bud.
No.
We're chatting
totally.
Thoughts, like, why not?
Yeah. It's because I think right now there is a over-indexing on how many winners there will be in AI. I think there's going to be not that many winners under $150 billion out there right now. I think there's going to be a massive, like the AI tsunami. I'm not exaggerating. I truly believe there's going to be like 10 software companies that will have a premium after this. Like, maybe if that. Like, I think it's going to be catastrophic. And I'm not saying it because I'm a fear monger. I'm hearing it from the words of these like CEOs who live on SaaS Avenue. Like, it's just a real big fear, guys. Like, gloves are off. Like, that is a common theme. And I think it's going to be very dangerous to be bullish on the theme, pick the wrong horse, because you wanted to get cute with like valuations, when if I want an investment that's going to be for 10 plus years, which that's my philosophy, like, I'd rather choose the clear winners and horses who won't die off in the race, that'll be there, that eventually once valuation will catch up to it, who knows what the next leg in that S curve is going to be. Like, A lot of people sold down NVIDIA when it was a gaming chip company. Nobody envisioned them being this engine for the whole AI economy. Like things change as like these themes continue to accelerate at such a rapid pace. You just don't know what's going to be like in 5. That's why.
We could even like roll into the whole Intel piece with as far as the CHIP Act's funding and also TSM. But to touch a little bit on what Shai was saying, as far as a company growing out their TAM versus what the market had expected, that could happen with any of the companies that we own. But also another company that a lot of people don't really talk about is Broadcom or AVGO. Like they used to be a straight up hardware company designing chips, designing network hardware and everything. And then they acquired VMware, and now they basically have both ends of those sticks on hardware and software. And that's why the stock is trading at all-time highs right now. And that's why it basically jumped like 300% in like the last couple of years, because actually, I think it's more than that now that I think about it. I think it was like 600% because Hock Tan made that move with its M&A. Also, if you think about Salesforce, for example, you think that they will really survive without doing all these acquisitions? They did it inorganically, which really isn't the best way to do it, in my opinion. But when you become a giant like Benioff had done, you kind of have that. That's the only choice you really do have to continue growing. And then finally, to add on to Intel, you know, there was the whole fact that they were competing against AMD for the CPU speed and everything. And then there was talk about them coming out with their entire GPU line and so on. Then now the foundry, which they had been IDM for quite some time, they're starting to be the foundry for the US, which I can still argue that TSM really is moving toward being a US company as far as bringing more manufacturing to onshore, especially in Phoenix. But at the same time, we've seen the news of what's actually happening here. Trump wants to bring manufacturing to the US, right? He wants to bring more jobs to the US. He wants the GDP to grow. He wants to take away basically that China risk in terms of having that overhang that China could really invade Taiwan at any point. Like that is literally a fear. If you're investing in the stock market right now, do not be surprised if that ever happens. I'm not saying it will. I'm just saying like that is the fear that you're putting your money into the stock market, hoping that won't happen. The likelihood it's going to happen is pretty low in my opinion, but he's taking out that risk because if he is able to take out that risk, that's going to create a lot of growth for our country as a whole. It's going to create a lot of jobs and so on. It's not going to happen overnight. But if you have all of these companies in the US, including Apple and Amazon, whatever it is, manufacturing a lot of their products and importing a lot of their goods from domestic suppliers in the US, that's really going to cause that boom you need in the economy.
Real quick, forget about the economy in the sense of growth, et cetera, or bringing back jobs here. Dude, we rely so much on Taiwan Semiconductor. I mean, they make 50% of the chips on Earth.
I think it's more than that, actually.
Yeah, and if China, like, which they constantly hang this over our head of like, if they decide to invade Taiwan, and then what? Then your cars don't work anymore. Your fridge doesn't work anymore. Like, I think we forget about the like national security risk right now. So I think more than tax and tariffs.
I don't think you'd have to worry about your portfolio if that happens.
Yeah, exactly.
So let's talk Intel a bit, because I think there's also a couple confusion on like what to do with Intel. Clearly, it had its best week since February. And it's down 7%. Last time I checked today.
Crazy,
like what's happening right now? Like SoftBank's investing, potentially government's investing. Like here's what's happening. I think on Intel, or what to know about what's happening in Intel. SoftBank bought in at I think it was $2 billion at $23 a share. It's now one of Intel's top shareholders. It's not huge relative to like what Intel's balance sheet is, but it does signal a potential ecosystem synergies with ARM, for example. Like everyone knows ARM is making their own in-house chips now. They're making that pivot away from being the Switzerland of hardware to like now they're potentially going to be a competitor. I think that with SoftBank's involvement, connect the dots. Intel, they're trying to hope that Intel maybe can help out ARM in that avenue. But I think that's like a nice vote of confidence what happened to SoftBank. The real thing is the U.S. government is becoming a hedge fund right now. First MP Materials, now Intel. Why is that? The potential 10% government stake, nobody really knows. Is this incremental on top of the CHIPS Act funds, or is this tied to the CHIPS Act funds? There isn't that much clarity on, is this just a narrative win that really doesn't change the actual dollar amounts? Either way, I do believe that it's unprecedented to see a direct U.S. equity position in a semiconductor firm like the U.S. government getting into Intel. I think it's a big deal. I think it could transform like what Sam's saying on Intel becoming this flagship of made in America chips. But the key is whether or not to know if this funding is incremental or just reallocated from the existing CHIP Act awards. But that doesn't solve the issue that right now Intel has. It's a massive issue. Like, a lot of people don't realize it's not easy to create a TSM competitor. Like, the problem isn't money for Intel, it's execution. Intel's newest chips process only works around half the time, while TSM works 90% of the time. You guys see how difficult already it is becoming a leader in AI machine learning. Imagine if your AI factory only works 50% of the time. You just don't take that risk. And their next chip, Panther Lake, it's delayed, and the one after that is on pause until they get a big customer, because guess what? Nobody's willing to risk the biscuit on an AI factory that works 50% of the time. And that's why Intel has been their own biggest customer. They have no big external customers. So yeah, I do believe the government stake would potentially keep them stable. It is a big narrative win, but the products still need to measure up. And Intel risks becoming more of this like government backed project than an actual real competitor to TSMC. And maybe that's why there's kind of a pullback in the stock where it went up 20%. Like, it went up a lot, but the issue isn't funding, it's execution. Like, they just don't have the tech infrastructure in place.
I would also say, I think what the market didn't expect, because it was actually pretty fun to just see how it pulled back so dramatically. Honestly, I respect Intel bulls who really been in it for the long run, because like they truly believe a company and they're sticking with it, right? Those people have been buying in these low valuations for quite some time. Obviously the story is going to change. I think the story is going to change over time. Like, there's no way the government's going to be funding all this stuff unless they believe that it was going to change, right? But also, I think the market thought that government was just going to start buying Intel in the open market, or they're going to buy it at its current price and not a discount. And I think the market was very disappointed that it was going to be at a discount. Like, there's no way that Trump is not going to buy a company on a premium. Like, why would he do that? Like, it's just, he's going to cut a deal with them, right? And let's be honest, there's a lot of mega cap companies that have kissed the ring or bent the knee, and Intel did it as well, and they're getting what they want. But I think it's a deal where both parties win. And you're starting to see, like you said, you're starting to see ARM considering building its own chip, which they've been like an IP owner or leader for quite some time, right? That was really what their moat was around. But then now they're going to start adding on to that, kind of re-rates how the stock is performing in terms of if they actually are able to bring that revenue to fruition. I mean, I think in a good world, Intel is going to come back. It's probably going to be trading at a much higher valuation from where it is today, maybe in the $30 range. And I think that story is going to play out. But I think you'd have to be somewhat patient for that to play out. But there are a lot of people who have no problem being patient when it comes to that sort of stuff. Yeah. Oh, go ahead.
No, I was going to say, like, they're the Clipper fans of the semiconductor space. Like, they're just hoping they're going to make it to the championship,
wow.
make a win. I'm a Clipper fan, guys. Like, yeah. I'm a Clipper fan, so I could
okay. So
make fun of us.
Okay.
No, like, I think ARM is a really interesting name, though. Like, I do think ARM. Oh, you're a Laker fan? Logical.
Come on, dude. How many banners you got, bro?
We have a lot of future banners potentially.
That's 0 for the audience.
Don't give me the Lob City was supposed to be like the final thing of like and disappointed. But either way, I digress. ARM Holdings is a really interesting name that I really want exposure. Right now, we can get away from semiconductors to go towards portfolio management a bit right now. I think that's a good pivot because you guys know I'm the Judd Apatow of investing. Like, I have great relationships with my holdings. It's a lot of emotional components.
Wait, who was that?
Judd Apatow of investing. It's just like I have too much emotional attachment to my Judd Apatow's. Are you kidding me? You've watched this. Don't age yourself. You've watched these rom-coms.
I mean, I probably have noted, but I just can't. It's not.
I worked in the entertainment, so maybe that's why. But let's just say it takes a lot for me to cut a loss because they have to really prove they've violated my trust. The thesis is breaking. I don't have enough conviction. Like, it's not like the one night stand potentially. I'm much more of a long-term boyfriend material. Let's just say that. And I think that I've cut 3 positions in the past 2 weeks, long-term multi-year positions. I think right now, that AI tsunami I'm talking about, it's not just in software, guys. We just saw what happened at Trade Desk. I don't think a pure ad tech company deserves a premium anymore. I think that what's happening is this controlled ecosystem, like what Logical was saying during season 1 on Trade Desk is premium, he ended up being right. Like I was
right with Magnite.
Magnite significantly outperforms Trade Desk, I think, since that episode. Jeff Green's, I think Sam and I were just like so gaga over Jeff Green because ever since Trade Desk's IPO, nobody believed they would just get a premium. Like nobody believed a pure ad tech name can get a premium valuation. Trade Desk was like a 50 times free cash flow for years. Like that, they're a premium. That premium is getting re-rated now because of what Amazon's doing with their ad business and the cloud ecosystem. What Google is leveraging AI to do everything for you now. And these agencies, like, you don't need that middleman anymore. And I think that, do you still own Trade Desk, Sam? Or did you also sell out?
Oh, I sold. For me, I should have managed it when it was like above $100. Like, I was just so dumb for not doing that. I've told you guys, like, one thing that I always do is that I tend to be inclined to think that the leaders in the industry will continue to lead. And if the whole sector, if that stock pulls back or if that company pulls back fundamentally and also on a technical basis, chances are the entire industry would too. And we kind of saw that when Reddit, AppLovin, Magnite, all those companies pulled back in terms of their ad tech moats. But I mean, we look at it today, every single other ad tech company, including Unity, which is starting to become like a big ad tech player in terms of the gaming industry, they're all trading at like higher levels than the Trade Desk.
Guys, can I
go ahead.
Interject? The Trade Desk is a Trade Desk problem, and it's not because of Amazon. It's because it was trading at 100 times adjusted EBITDA.
Well, no, I'm saying it's a problem because you don't deserve a premium valuation anymore.
Yeah,
and
I mean,
Trade Desk was the premium.
I get that 100 times adjusted EBITDA when other things are trading at like 8-10 times have much better tailwinds. This thing had headwinds and we're trading at a premium multiple. I'm just saying this is again, I don't want to go back to Palantir, but my point is just saying when you have a high valuation like that and you don't end up delivering quarter after quarter after quarter, which by the way, the Palantir has done, and which is why we all thought it was overvalued at $75 and it went to 100, then 150, then 180, is because they continue to deliver. That's fine. But, and Sam mentioned this earlier, as soon as you give that bad quarter, it's done. You're over. Your premium multiple gone. We all agree to that. But that's why when you deal with a company like the Trade Desk or any company that trades at a premium valuation, when you head into that print, it's got to be a lot more anxiety. It's got to be a smaller.
Well, exactly. That's why.
But
go ahead.
It is so different, though, those businesses. I do want to interject. Like, I hear what you're saying. Like, high valuation has to perform perfect every single quarter, or you're risking just like having a 40% drawdown. I want to call out, though, that the government side of like Palantir's business has been 50% of their business for every single quarter. So, like, they have. In a way, they're always going to be continue spending up more and more. Like the government, the incremental increase in the DoD budget every year is going to go towards the new age of defense. You guys hear me saying this all the time. Palantir is going to be scooping that up. So I think that Trade Desk, like ad tech, is something of a nice to have, not need to have, because there's so many alternative solutions out there. And Trade Desk platform was like very easy for all these agencies to use. And Kokai, oh my, I'm blanking on the new product for Trade Desk, their AI one, that was poorly released. Like they had no CEO in place.
Well,
and there was
that was the major problem that you and I both agreed on when it basically got its head chopped off with a problem with the CEO. And just you have Jeff Green basically running the operations company while leading the company as well. It was running a little bit thin. And even on top of that, when you have an operations problem in a company, that really throws everything off the guardrails, because then now the product team is pretty much they're trying to work with the service department and so on. Like you need that head figure there that's been with the company for a long time to guide the company toward to direct the ship toward the right direction. And I mean, yeah, they're able to get to that, but at the same time, it was like he was even talking about agile problems and everything during that conference call when the stock basically had like a 30% haircut, like at the beginning of the year, right? And then we came into this quarter, the things are starting to look better and everything. But like, I'm not going to lie. I got very shaky feet in June. And that's when I was like, you know what? I need to start consolidating my portfolio, because we're going to talk about portfolio management for a little bit. And I need to start concentrating my ad tech positions into maybe one or two companies. And I did do that. And, I'll pat myself a little bit on the back, but I would have rather focused on a company that was expanding its reach in ad tech. Like, for example, AppLovin, like they're going to be getting into the territory that Trade Desk is in. Yes, they're not going to be changing the entire business of how ad tech has been as far from a product perspective, but like they're going to be getting in there, and it's only a matter of time till more companies start getting in there. And on top of that, you have these other companies, like you were mentioning Amazon, Google, and Meta and everything, like they're walled gardens, right? They can easily offer their own products in-house, which we've already seen from Amazon, especially partnering with, I think they partnered with Roku, but these companies are going to continue doing that because they want to continue expanding their margins on these very high growing businesses that they do have within their own company. And like we're talking about the AI tsunami, when it comes to software, companies want to consolidate. So app rationalization is always an ongoing project for almost every single company around the entire belt, right? They're always going to want to consolidate how many platforms they're on. You saw that with Palo Alto and Nikesh Arora, would basically he went for the platformization approach, and yeah, he did cannibalize a little bit as far as the revenue goes for a little bit, but it's obviously working out, right? Like companies don't want 20 vendors; they only want one or two, and they're going to keep on working that way because you can cut deals for those one or two vendors. But when you start stringing yourself thin, you're thinking about different integrations, you're thinking about different relationship with these vendors and all these patches, whatever it is. That's where it starts to become a problem, and that very well could be what we're going to start seeing with a lot of software stocks, where you're going to have a lot of companies that were one of like 5 different products being used for the same solution in a company to maybe only 1 or 2. And what's going to happen to those other 3? Maybe Confluent's going to happen.
I mean, yeah, Confluent is that real fear. I do want to go more towards portfolio management because we talked a lot about Palantir. And I think that
we never talk about Palantir.
I think it was like half the episode. I think it was justified. I think there was some misinformation out there, and it was also good to see our philosophies regarding a high beta stock like that. But portfolio management's logical. How are you maneuvering this week? 'Cause I know when there's a lot of volatility, it is the prime time to reallocate your priorities on how you want a portfolio looking going forward.
Yeah, I kind of talked about this at the start of this space, basically what's been going on, but it's still a chop fest out there. So I've, as much as I was hoping that breadth was picking back up, and it really has because RSP's been green while SPY hasn't been, it still feels really choppy, and it's not like that easy uptrend. You can make all your money in 3 months and it's just up and to the right trending. So it hasn't been that. So, with these kind of false breakouts, I mean, I don't know if you saw the charts. I mean, Magnite, for example, is something that's been put into that high beta Momo stock box, which doesn't make a lot of sense to me. That thing had a beautiful setup, higher lows, and then poof, you get a day like yesterday, and that thing has a huge red candle, slices right through the 50-day. I mean, those kinds of moves make me think, all right, dude, we're still definitely in chop fest. I'm not getting overly bearish, but you know me, I run margin, I run leverage long. So I took down a lot of that exposure. I got back down to, only the core positions. I don't want to unnecessarily bleed performance. I'm still up 90% or so on the year, so I'm feeling great, but I don't want to give back those gains. And so, I was, again, 150% long, but then after I start seeing this kind of price action, which really just doesn't make me feel all warm and fuzzy inside, I want to lay off that gas pedal, and I just want to get myself back down to a more reasonable exposure. Like I got myself back down to 100% today. People are like, oh, you're getting bearish. No, dude, I am fully invested. I'm just not ridiculously invested. And that's what I did. I don't have any short dated options. I took those off a couple of weeks ago when I felt like, remember that one ugly Friday we had where like software was puking? I took all my short dated calls off. I realized some gains. I booked some losses. Earnings season was very volatile. I booked some losses. I'll revisit some names in 30 days when my tax loss selling period is up. But I just wanted to, take my foot off the gas, let the chop fest deal with it. We got Jackson Hole, Jay Powell on Friday. I don't really expect much. I think it'll be a nothing burger. But in the meantime, when you have Fed minutes today coming out and saying, oh, inflation is a bigger risk than jobs, blah, 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 like all this stuff of the back and forth and the pendulum swinging, like, dude, I don't need to be fighting tooth and nail for a higher performance. I just need to make sure that I maintain my current performance. So foot off the gas a little, willing to put it right back, pedal to the metal, but I am sticking to my highest conviction ideas. I never go overweight anything. My highest size is around 8% right now. So I'm fairly balanced. I have a good portfolio. I got a mix of bios, tech, software, industrials and financials, etc. Tiny bit of crypto. The Ethereum has been real strong. Very balanced portfolio, and just managing. Yeah. Anyway, sorry, Sam. How about you? How you doing?
No, I mean, Ethereum has been real strong is an understatement with Ethereum, man. Seriously, Tom Lee has been riding that ship for quite some time. Yeah, I mean, unless you guys have anything else you want to add on, I think that would cut it for this episode. You got anything else, Shay?
Have the dry powder, guys. Like, I do think things will get worse before better. I think that we had a great bounce today. I love the bounce today. Everything's setting up to look like it was a 2-day bloodbath, but I don't know. I'm just really getting the exhaustion vibes, and I think that seasonality weakness is real. I think that Powell is going to be the Grinch. I think that Friday, I wouldn't under-index how hawkish he's going to be. I think that might be a real drag down, but also Ethereum and Bitcoin, these are indicators on risk on. I could care less what anyone says. They've been proven that if those bottom first, equities follow suit. I think Ethereum, you guys just mentioned, like it's showing a lot of strength. Be Bitcoin miner, Bitmine.
Can I just interject? Sorry, just because on this topic, I think we've seen crypto actually start decoupling during this administration. Like, remember when it was like back at the tariff lows, Bitcoin held up extremely well. It was holding up like gold. But
that was the indicator of V-shape, though. You should buy the dip then because they were holding up well.
I would say that Ethereum has actually been stronger now than Bitcoin has. Definitely. If you look at the ETH BTC chart, it's been breaking out. And to me, it feels like Ethereum is a better measure for risk on. And I think at the same time, Ethereum is actually going through a re-rating process right now, which is why it's been my preferred holding for crypto exposure. So I don't know. I would say that crypto has made a lot of strides under this administration. We're seeing there's a lot of different reasons. We can maybe talk about this next time, but tokenization of assets, Coinbase's base platform. There's USDC, which is the stablecoin of choice by Circle, which is on the Ethereum blockchain. There's a lot of reasons why Ethereum is going through a re-rating process right now. But yeah, I mean, I agree with you, man. Like, I don't think this is the end of the bull market. The bears love to come out and pump their chests. No, should we have a reset? Yes. And sorry, I didn't mean to cut you off, but like, yeah, it's not the end of the world. Reset is fine. Like, but in the meantime, there's still a lot of this BS political back and forth between the Fed and Trump. And, are rate cuts coming? Are they going to be delayed? Are we going to have as many as we thought? Like, why bother fighting with some of those things? I mean, I would say the home builders are showing signs of that they've bought them. Buffett's buying them. Others are buying them. So maybe, there is that rate cut trades prepping. But in the meantime, it's kind of like, let's just wait for some confirmation before we get too aggressive on that side, because they're going to rug pull you every single time. And it's just really annoying.
Yeah, one last thing. Like, if you guys felt fire in your belly this week, you got too much in the market. Like, I think those are a good gut check on, like, maybe you're overexposed. Take some dry powder, put on the sidelines, so when things get really ugly, like VIX at 30 plus, you can capitalize. There's nothing wrong with. There's no shame in trimming 15% across the board, putting on the sidelines just so you don't have that fire in your belly when things pull back for 2 days, when it's been going up nonstop for 2 years. Like, I think just be aware of yourself, guys.
And it's okay. And sorry, one last comment on that, because it's okay to like not, oh no, everything fell 5%, 10%. I should have trimmed then. It's like, dude, markets don't look backwards. They look forward. You didn't trim the exact top. You could still manage your risk. Like, it's okay to not trim the exact top is what I'm trying to say. You don't have to price anchor, that kind of thing.
I mean, I think even for people who don't do trimming, where like they literally just buy and hold, I think now is probably a good time to relax with the buying, if anything. Or you could just continue buying the SP 500 every single day and make your lives probably a lot easier than our lives would probably if we did do that. But at the same time, I mean, if you have to look at your portfolio all the time and you're worried about the stock market falling and stuff, like that just really tells a lot. You got to listen. You got to listen to what you're thinking. You got to listen to how you want your portfolio to be built, like what kind of secular themes you want to focus on, and then head toward there. I think also, there's a lot happening in the market. This is probably going to be, I don't think earnings season is over because we got NVIDIA next Wednesday. That's going to be a big day. Obviously, we have Jackson Hole on Friday. I think it'll be an option selling event for both of those days, but at the same time, anything can really happen toward the end of the month as well. But on top of that, for me, next week is not just NVIDIA. Next week is a lot of software companies that are reporting. On Tuesday, we have Okta after close and we have MongoDB after close. Pinduoduo is actually reporting Monday before open if anybody's interested in the China companies. Wednesday after close, of course, NVIDIA, but CrowdStrike and Snowflake. Of course, Snowflake.
You're kidding. They're both reporting on the same day as NVIDIA.
I don't know why
I'm going to be so sad.
Swami have to do that all the time. I mean, this could be a double whammy for a lot of people. If NVIDIA doesn't really impress and Snowflake doesn't impress, I have no idea what's going to happen for that day. But Snowflake is notorious for having big moves after earnings. We also have HPQ or Hewlett Packard reporting. This is coming after their acquisition of Juniper, so it'll be pretty interesting to hear about that one. Like I said, CrowdStrike is reporting the same day as well. That one actually has pulled back pretty considerably from its recent highs. Pure Storage as well, Build.com, NetApp, and a lot of other companies. And I think that would really tie it in. I mean, there's a few other cards reporting on Thursday, including Elastic and a couple of other software companies. But I think that would really mark the end of like the mid-cap, large cap companies reporting. And then in September, we have the smaller cap software companies. And I think that's when Logical's portfolio starts to really have its moments, especially with GitLab.
I don't know about that. We have Okta next week for sure, but then GitLab is the following week. Maybe Braze coming up as well. But besides that, I'm mostly through earnings at this point.
No.
Yeah. It's actually very interesting. In a couple of weeks, we're going to be having Iron. Actually, no, that's not TeraWolf, but a lot of the Bitcoin miners are actually reporting later next week. So we'll see what happens with that one. But anyways, guys, you guys got anything else to say before we head out?
Pray for me on Wednesday. I guess it's do or die day for me. I didn't realize how it's going to be a tough one, guys. So be prepared.
All right.
I'm scared. I'm personally scared for Wednesday. We'll see.
It'll be fine. You'll be all right.
You'll be fine, man. Don't worry about it. Don't worry about that. It's going to go by very quickly.
Yeah, survive the chop, guys. Make it to the other side. We'll be good.
All right, guys. Talk to you later.